Well, hello everybody. This is a brief introduction to the accounting ratios topic that is one of the last topics to look at in the financial statements paper. And I'm splitting this up into 4 separate short slide presentations so that you don't have to watch them all at once. And I'm also going to switch off the camera so that you don't have to stare at me all the way through this slide presentation. It's a really important topic, not only in this paper, but in others as well. In the financial statements paper, it's the last topic in the paper in question 7 and 8, and it accounts for 43 marks, which is 29% of the total marks in the paper. Question 7 is a calculation question, question 8 is a written question, and that's the one that people seem to struggle with, and we'll spend some time looking at that later on. You'll also come across ratios in the budgeting paper as well as in the decision making and control paper, and most importantly it will also crop up yet again in the final synoptic exam. So the better you learn it now, the easier it will be in those future papers. There are a few problems with the ratios though, and that's the main one. There is no reference material whatsoever, so you'll need to try and remember the correct formulas. There are various things that can help with that, and in particular you need to watch out for this. Very often in questions you'll be given the ratios for one financial year and then asked to calculate them for a second financial year. In that case, it's easy to make sure that you've got the formula correct by recalculating the ratios for the year that are already given to you, and you can then apply those to the second year. And as I say, their calculation is easy with practice. And it's only with practice that you'll be able to remember the formulas. What is difficult is the interpretation of the ratios, and that requires a bit more thought, some reading, and some discussion as well. It's easy to lose marks when you come to write the interpretation question. The textbook lays out the ratios in a number of different ways. I'm going to look at them in three sections. Firstly, the ones based on the profit and loss account, a few basic ratios there, looking at profitability and how efficiently the business is being run. Then a separate presentation will look at how the business is managing its working capital, really debtors, creditors and stock in particular. And then finally we'll have a look at the ratios that investors are likely to use to determine how well the company is doing from their point of view. BPP in the book split them up in a slightly different way, but the formulas will be the same. And if you look on page 309 of the textbook, you'll see that there's a summary of all the formulas. The one thing you must realize, a bit like the cash flow, is that there isn't a vast amount of information available to use when calculating the ratios. An awful lot of assumptions are needed, similar to the ones that were used in the cash flow. And in particular, you need to remember that the balance sheet only shows the financial position at one moment in time, and if transactions have taken place near the year end, that could distort the ratios quite significantly. For example, if there's a particularly large sale right at the end of the year, that's going to increase the trade receivables, and consequently the debtor days calculation will be affected by that. Also, when we're looking at some of the other ratios, the assumption is that any additional capital that's been paid into the business has been there and available for use for the whole of the accounting period. And if it's only been introduced towards the end of the year, that again will distort the figures. So in themselves, the the ratios are very rough and ready. And remember, different companies use different methods of stock valuation, different methods of depreciation, and so on, that will distort the figures also. So the most useful thing with ratios is to be able to compare 1 year's results with another, because no matter how rough and ready the calculations are, if the accounts are prepared in a similar way, then the figures are comparable. Remember, that's one of the enhancing characteristics, isn't it, of the financial statements, is comparability. So provided the accounts have been prepared in the same way for both years that we're looking at, the ratios are comparable as well. One of the main problems that students come across is the question asking for commentary on ratios. Those questions will be looking for one of two things: either possible reasons to explain the change in the ratio from 1 year to another. Most questions won't give you sufficient information for you to be able to identify the actual reason. Your answer should just make suggestions as to what could possibly have caused a change, and then you'll be expected to say what, if anything, the business needs to do to improve things in later years. So when you're writing a written answer, I'll suggest you maybe go a bit over the top really with what you're writing, but I would start first of all by stating what change has taken place from 1 year to another, the amount of the change and the percentage change. We'll look at these later on. When you've actually stated what the difference is, say whether it's a good thing or a bad thing and why. For example, if the gross margin has improved, if the gross margin has increased from 1 year to another, then you could say that's a good thing because it will mean a larger percentage of the revenue is available to cover overheads and add to profits. And then you need to suggest possible reasons for the change, and then finally suggest what the business needs to do if there's improvement needed. For example, if the trade receivables debtor days figure has increased, so customers are taking longer to pay, then the company really ought to review its credit control procedures, that sort of thing. So that's just a suggestion of how you might approach the written questions commenting on the ratios. As I say, we'll look at these in more detail later on. You might also need to comment on some of the figures that doesn't really involve the calculation of ratios, but you do need to comment on changes from 1 year to another. And when you do that, it's always best to show the change in two ways. Firstly, as the actual amount of the change from 1 year to another, but then also express the change in percentage terms, because that does make a difference. If we just look at these two, expense number 1, if I can do this, that's actually increased by £80, and if we look at expense number 2, that's actually increased by £700, and that's clearly in monetary terms a bigger difference. But if we convert those changes into percentages, if we look at the first expense, it's gone up from £200 to £280. That's an increase of 40%. If we look at the second increase, from 4,500 to 5,200, that's going to be an increase of a smaller amount. I'll just have to work out what that is. So that's about 16%. So you can see in percentage terms the difference is much bigger for the first expense, and so the difference between the 2 years is more dramatic in percentage terms. So that might indicate a need to review that item as well. So when you're commenting on changes, use both. Use the actual amount of the change, but then convert it into percentage terms as well. So there will eventually be some more slides that will look at the individual ratios, the profit and loss account, the balance sheet, and so on. And I'll be putting those up in due course. What you need to do now, that you've worked through this brief introduction, is to download the PDF file that I'm uploading, that contains 2 years balance sheets and profit and loss accounts and a list of ratios. We'll be using those in the other presentations, but the first thing I want you to do is to have a look at the textbook. If you look at the start of the interpretation chapter, you'll get all the formulas there, and see if you can work through both years on those sheets, doing the calculations to 2 decimal places. So have a read through that chapter. I think it's chapter 11. Have a read through that chapter, have a go at doing the calculations, and then next week we'll look at those in more detail, and we'll have a look at possible reasons for changes in those from one year to another, and the way that you should approach the written questions.